Hey guys, in this very final lesson here in Principles of Accounting as well as Section 12, we're going to be talking about some of the disclosures that you need to do or have on your statement of cash flows. And what we're talking about is at the end of your statement of cash flows, you have your reconciliation, which is your reconciliation from beginning to ending balance of your cash with your changes that you did in the operating, investing, and financing section of your statement of cash flows. And then underneath there, you may be required to put some additional disclosures, and that's what we're going to help you understand in this lesson. So let's take a look at the statement of cash flow disclosure. So after preparing the statement of cash flows, there are two disclosures that are needed to be reported after the reconciliation section of the statement of cash flows. The first disclosure you're going to need to report is cash paid for taxes and interest. So after, you're going to put cash paid for interest and taxes. Now, those are normally in your operating section. So we're not changing the reconciliation at all. We're just saying of the balance that is in the operating section, we do have cash paid for taxes and interest, and this is the amount. Why? Well, we'll talk about that in a minute, but they're an important part to understanding what the company is spending their money on, especially when it comes to taxes and interest, which is of a lot of investors' mind when it comes to cash use. The other disclosure that we're going to need to know is significant non-cash investing and financing activities. These are activities that don't necessarily impact cash, but have a big impact on the balance sheet themselves. So let's take a look at each one of them individually and help you understand what we're talking about with these disclosures. So the first one here is the cash paid for taxes and interest. So cash paid for taxes and interest are normally located in the operating section of the operating section as part of net income. So it decreases or increase, well, cash paid. So it decreases net income. So it's baked into net income, but it's a function of net income. So at the end of the day, what we do is we report this at the very end. It's already baked in. So we don't do anything to the operating section. We just leave it. And we just put another disclosure saying cash paid for taxes, X dollars, cash paid for interest, X dollars. So because of the importance of these items to investors, and because they involve not just the operating section, they involve really all sections of the statement of cash flows. These need to be reported as an additional line item after the reconciliation. So all you're doing is you're just putting a line, taxes paid, interest paid, and we're done. Okay, so that's one disclosure you're going to need to make on the statement of cash flows. The second one is significant non-cash investing and financing activities. And really this has to do with oftentimes purchasing investment items are done using financing items. So no cash is exchanged. We literally change one thing for another, and they have a huge impact on our balance sheet. So if I were to buy an equipment that costs $500,000, I might take a loan of $500,000 and never see the cash aspects on my statement of cash flows because it doesn't actually have cash exchanging my hands. So in that case, we're going to report this on the end of the statement of cash flows. So oftentimes purchasing investing items can be done with financing tools rather than with cash. These can be significant to a business. As such, after the reconciliation, you should list significant non-cash investing and financing activities and their amount. So if I bought an equipment using financing or debt, then I need to put purchased equipment, $500,000 with financing debt or something like that. So that investors know that, hey, you were able to buy this, but you didn't buy it from cash. And so it doesn't impact your cash statement, but it's important to know from an investor standpoint. All right. So what does this look like? So here's an example of a company's disclosure after the statement of cash flows. So if you notice here, we've got our income taxes and we've got cash paid for interest. And again, we're just listing the amount. That's about it. Nothing big to understand there. Then if you notice here, we have some non-cash investing and finance activities. So change in accrual for property and equipment. So that probably means that they purchased equipment or property in exchange for debt. So that's a non-cash investing and financing activity. So that's what we have there. They've got some non-cash dividends. So they paid some dividends, but they didn't use cash. So stock dividends. So that's an important one, especially here, 56,073. And then property and equipment acquired under build to suit leases. And again, that's advanced, so we don't really need to talk about that, but that is also impacting the non-cash investing and financing activities. So again, all we're doing is listing them and then the amount, and then we're done. So nothing complex here. We're just telling investors you should know this when you're reading our statement of cash flows. Otherwise, these things would have to be paid in cash, at least the top part. And from the income tax and interest, that's just splitting it out to help the investors know those numbers. So hope you enjoyed this statement of cash flows disclosures, and hope you enjoyed this course on financial accounting. So until then, we'll see you in maybe another video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.